Well, welcome back, everybody, to Markets Mindset. It's been a while. I have with me, as always, Moshe Tomkiewicz, head of DCM here at Mizuho. And Moshe, it's been an interesting, I'll say, post-Labor Day period. To give you an idea of the background before we get into it, we've had record supply for the last 3 months, 3 monthly records in a row. We went from being negative gross supply to positive. We're now up 9% on the year gross supply, 6% positive on a net supply basis, although we're actually negative net supply if you take into account that we've already paid down $140 billion of maturities for 2026. When we walked in this year, 2026 was supposed to be over $1 trillion in maturities, which I think some dealers are still counting, but we've actually paid down $140 billion of that already, and we're down to $880 billion staring us in the face for 2026. But at that exact same time, we got hit with, let's call it, for something lack of a better term, the data center issue, which came up, and the supply out of the tech center at the exact same time. And we've seen spreads retrench from a low of 71, 72 around September to now hitting 84, 85 on the index. And interesting enough, the first move wider was on September 19th, just after the Oracle transaction on the 18th. And the second move wider was after the Meta transaction on October 30th. And in between was the announcement that the Beignet transaction, the data center deal backed by leases of Meta, had also hit. So you had a ton of supply come in that period. And since then, we've been just proceeding higher in spreads. Where do you think we're going in spreads? How do you think we're going to enter 2026? And what's your view forward?
So I think December is going to tell us a lot about what to think about longer term. You have the Fed on the 10th. We expect an active week in the market that first week in December, and then we're going to be in a period of basically no supply, and if there's supply, it's just going to be episodic. So that is the time for this market to recharge the technical battery. If we're able to get below, let's call it 80 on an index spread perspective, which is called 5-6 tighter than where we are right now, then we could have room to run. My guess is that we've hit a floor, and that's just a byproduct of the supply.
Floor being 80 or the floor being 85?
I think the floor is the early September floor, but I think the 80 is going to be a very hard level to break, because I think, and I could be wrong, when we get into this period of no supply, all the buy side is going to do is talk about the calendar for next year, because you're going to have guys like me and you talking about all the ingredients being sown for a record level of issuance.
We're already hearing some of those numbers come out already. $1.7 trillion to $2 trillion expected for next year. I know we haven't put in our estimate yet. We're gonna wait because we're gonna be back. Here's a shameless plug. We're gonna have our next Markets Mindset on the heels of our annual survey that comes out, so we'll discuss it then. But that's a pretty big number heading into next year. That's going to be a record number almost.
Yeah, and I mean, think about it. You're going to have $1 trillion capital need from the IG markets between now and 2028 just for data center driven supply. On top of that, we expect an elevated M&A environment. I think anyone who is considering a transformational acquisition is going to want to do it when the regulatory backdrop is fairly light. So that's going to come into fold. And we have close to $1 trillion maturing next year. So you add it all up, 1.8, which I think is the old record, feels eminently doable. But it's a lot of supply for the market to digest. And I think it's a price issue, not a capacity issue. But we were dealing with nosebleed type valuation levels, and I just don't think it can hold given that supply backdrop.
I mean, you're right. If supply continues, I mean, here we're at almost approaching 250 billion of tech supply. Not quite there yet, but pretty close. That's a quarter of all corporate supply this year. Now, interestingly enough, there was a change in the composition of supply this year. For the first, I'll call it, 9.5 months, duration reigned king.
Yep.
Issuers wouldn't issue it. Investors wanted to buy it all day. And then something seemed to happen. If you take a look, issuers issued approximately $3 billion to $4 billion a week of long-dated 20-year plus securities every week through October. Then from the last week in October to today, it's been about $11 billion per week in 20-plus long-dated supply. That's a big change from the issuers in terms of the pace of long-dated supply. At that same time, we also saw underperformance of long-dated supply, right? We saw this from some of our deals. Some of the longer-dated deals, the attrition rate, right? The drop of the book from IPT heights to pricing were over 60%. And then we saw underperformance in the secondary market. Do you think the performance or the underperformance was caused by the increased issuance? Or do you think that the underperformance was caused by a change in investor sentiment because of ambiguities around the Fed, the employment number, the new CPI? We didn't have an October CPI. All the data coming up in December, people just becoming more cautious.
I think it's 98% supply related. The market got a ton of duration to digest. I mean, remember, you referenced that Beignet transaction when we first started this discussion. That had a weighted average life of close to 17 years. Okay, so that was sold to our buyers. All right, and then on top of that, you had more supply. So you've had a lot of duration, and it's coming from a sector that one thing we know of is that they're going to come back, and they're going to come back a lot. So you basically had commodity duration thrown at the market, and I'm not surprised at all that the market's taken a little bit of a pushback.
So do you think this outperformance is going to continue in the front end, call it 5 years and in, which is where we've seen things outperform recently in particular? I mean, I take a look at one of the trades we worked on last week, the 2-year floater.
I would call
probably one of the best performing assets we've seen in a while.
I would call it more demand normalization than
more balanced at this moment than having that strong bid for duration that we had for most of the year.
And Victor, the one other thing that we haven't talked about for next year, like we could talk about the impact of supply on spreads. What we don't know is the tail risk in the market. And I think we have a market that has elevated tail risk, especially for credit, because this whole sell-off that we've seen in stocks, specifically in AI, has been credit related. And we also know that assets under management in private credit have basically doubled in 2 years, and the banks have that excess liquidity to deploy. Mistakes are going to be made, and probably may very well have been made. And we know that they'll get magnified 10x when they happen to make them feel a lot worse than they actually are. So what I'm trying to say is that this spread outlook I'm giving you doesn't factor in those tail risks materializing. If those tail risk materializing, that view gets that much more accentuated.
So I think it's safe to say you're a little bit bearish on spreads.
Yeah.
Okay. Katie Levino has dialed in a question from Staten Island, New York, longtime listener, first-time caller. And she wants to know that over the course of time, you've talked a lot about the $7 trillion of dollars that are sitting in money market funds as a backstop that would push out the curve and start buying spreads. One, how do you factor that view into being bearish on spreads? Or two, do you just see it that that's part of what's going on here in the front end of the curve, is that those assets are pushing out, looking for yield, looking for additional spread? How does that factor in now, given your view?
Well, I think the migration out of cash has reversed in the past couple of weeks, given everything that's been going on that's AI related. So you've seen cash levels actually increase over the past couple of weeks. So I think last data I checked, there's close to $7.7 trillion. Is that a backstop for the market? Yeah, I think it is a long-term backstop for the market. But the question is at what level? Because you're dealing with a situation that if you spread it out, has some potential systemic concerns. And we know people will feed off of that. So cash isn't necessarily something that's burning a hole in people's pocket.
So you think if that treasury curve continues in the front end, at least to flatten and invert in some cases, that cash is going to go back to where it was a few years ago. It's going to stay in cash because it's earning an outsized return.
And you made the point too, is like, we don't know what's going to happen with the Fed now, right? And again, if I'm sitting in cash and there's a lot of volatility in the risk markets, let's see what happens with the Fed.
So Moshe, switching topics here quickly to hybrids. A lot of changes have gone on in hybrids over the last 2 or 3 years. Supply has ballooned the last 2 years. The structure has changed. Where now the dominant structure is the use of the floor, which I don't mind saying Mizuho was the pioneer in terms of getting the floor approved. It's been one of the last salient changes in hybrid structures in the last decade, you could arguably say. But my question is, it's become more mainstream, it seems, or going outside its normal avenues. It's going outside the utility space. We saw Verizon do an extraordinarily successful trade in euros. Slightly different structure than we use in the States, but incredible trade that came well through its dollar equivalents. We obviously saw CVS use it at one time. There's a lot of dialogue going around on hybrids. Where do you see the use of them going forward in some of the sectors you cover in the broader space of M&A or in rating agencies and other industries?
I think you're going to see it playing a much more prominent role in M&A that you've done in the past. Now, for some of these mega acquisitions with mega companies buying each other, then probably not, because it's going to take too much to move the leverage needle. But those companies kind of, with that call it $20 billion debt portfolio, who are doing an acquisition, and where some form of equity is needed from a balance sheet perspective, 100% that's going to be part of the dialogue.
Okay.
And what we've seen, if you have a stable market and we have the floored reset structure that you spoke about, there's a lot of capacity for that type of structure.
So Moshe, let's finish on a prognostication. And you can't equivocate on this. So we don't really have a ton of data coming up that's that important until we get to CPI and the FOMC meeting. We've had a lot of different calls here. Are they going to ease? Are they going to not ease? I remember at one time a Fed ease in December was down to 35%. Now we're back up into the 70s. What's your call for an ease or not an ease? And what's your call for the leaning on the commentary afterwards?
I think it's a reluctant cut. And I think that because in the absence of data, this Fed has shown tendency to be hawkish rather than dovish.
And what happens if they don't cut?
I think if they don't cut, it's a dovish pause. So I frankly don't see a huge delta between a dovish pause and a reluctant cut.
Okay. Well, Moshe, thanks again for being here on Markets Mindset. And I look forward to seeing you next time. We're going to actually be doing one shortly when we get all the responses from our annual survey in, over 300 accounts, coming back on 20 of the most important questions of the day for 2026. I hope you'll all join us. But until then, thanks again.
Take care.